Let's dive straight into this highly anticipated ACE market listing for Soom Technology Berhad and see what's really under the hood. Welcome to this explainer, where we take those dense, complex financial prospectuses and turn them into clear, actionable insights. If you're a Malaysian retail investor eyeing the upcoming IPOs, this one has definitely crossed your radar. Soom Technology is looking to raise just under 33 million ringgit, and honestly, there's a ton of buzz surrounding it. But, as we always do here, we need to separate the macro hype from the micro financial reality. So, at an IPO price of 28 cents a share, we're going to find out if this data center and semiconductor play is actually worth your hard-earned money. With applications closing on June 4th and a listing locked in for June 18th, the clock is absolutely ticking. Now, the market is undeniably hungry for tech-adjacent stocks right now, but you need to know exactly what you're buying. So, grab a coffee, get focused, and let's break down the core strengths, the glaring risks, and the peer evaluations you need to understand before making a move. Okay, part one, the Soom Technology story. Before we get into the heavy financials, let's understand the actual business model here. Soom Technology essentially builds the vital guts and precision cooling systems for high-tech buildings. We're talking major B2B clients in some seriously booming industries. They build clean room environments, which require absolute zero particle conditions for semiconductor fabrication, and they actually named Unisem as one of their customers. They also handle MEPF, which is a mouthful, but it stands for Mechanical, Electrical, Process Utilities, and Fire Protection Systems, alongside manufacturing custom MVAC units. That's mechanical, ventilation, and air conditioning. Basically, think of these as massive, highly precise climate control systems. They are literally the mission-critical life support systems for data centers and EV battery plants. Now, what's really fascinating about their business is this one-stop, turnkey model. They aren't just doing one tiny piece of a massive puzzle. They're handling the entire project lifecycle. They design the custom facility, they manufacture the ventilation products right there in-house manufacturing base, and they handle the final installation and handover. For a client, this is huge. It means they don't have to juggle 5 different contractors, which massively reduces project risks and delays. This end-to-end capability is for sure a major competitive advantage in this sector. Moving on to part 2, riding the mega trends. Here's exactly why institutional and retail investors are paying such close attention. They are planting their flag right in the middle of massive global investments in AI infrastructure, specifically by aggressively expanding into the Philippines. And listen, this isn't just about getting a new office on a map, it's a highly strategic financial play. By capturing data center contracts over in the Philippines, they are securing strong US dollar-denominated revenue. For a Malaysia-based company, that acts as a fantastic natural hedge for the ringgit. It provides a lucrative upside that frankly has a lot of investors very, very excited. But here's where things get a bit tricky. We've got a classic tug-of-war going on in the analyst reports. On one hand, the macro tailwinds are incredibly bullish. Riding that semiconductor boom, expanding abroad, leveraging experienced founders. It sounds great, right? But on the other hand, when you look at the micro-financial data, there are some glaring red flags that we absolutely cannot ignore. To really grasp what's going on, we have to pull back from the exciting macro story and look at the hard math. Which brings us to part 3. Peeling back the financials. Let's see if the numbers actually match the narrative. If you dig into the prospectus, the first thing you'll notice is extreme revenue lumpiness. Now, that's fairly common in project-based contracting, but look closely at FY 2024. That is a shocking 42% top-line drop, falling from over 88 million down to just 51 million ringgit. Sure, they bounced back a bit in FY 2025 to about 65.6 million, but they are still nowhere near that FY 2023 peak. As an investor, seeing inconsistent, shrinking revenue is a metric that demands serious caution, especially when the company is pitching a high-growth story. And then there's this number, 126 days. Think about that for a second. This is their receivables timeframe. It means that after they finish the hard work and send out the invoice, it is taking them over 4 months to actually get paid by their clients. In a normal, healthy business environment, a standard billing cycle is what, 30 to 60 days? Stretching out to 126 days is highly abnormal. In the contracting world, cash is king. When your cash flow is stretched out this far, it puts immense strain on day-to-day operations and forces you to rely on working capital just to keep the lights on. It's not all bad news, though. They have actually managed to double their gross margins from 13% up to 24% over just 2 years. How'd they pull that off? By deliberately pivoting away from standard cleanroom construction and moving toward higher-margin, complex utility work. Essentially, they traded high-volume, low-profit work for lower-volume, high-profit work. That's fantastic for profitability. But the trade-off is a shrinking overall revenue base, sitting at a negative 7.6% compound annual growth rate over 3 years. Their top-line revenue has been steadily dropping. All right, part 4, valuation versus industry peers. So we have great margins, lumpy revenue, and stretch cash flow. Let's tackle the ultimate question. Is that 28-cent price tag justified? To answer that, we have to look at the trailing price to earnings or PE ratios of their closest competitors. At an IPO price of 28 sen, Sumtech launches with a market cap of 126 million ringgit. That gives it a PE ratio of 20.7 times. They're pricing this as a premium growth stock right out of the gate. Notice how it sits way higher than its main market peer, Critical Holdings, which trades at just an 8.6 times multiple. It's slightly cheaper than the ACE market darling iSense, sitting at over 26 times. But remember, iSense commands that premium because they have sticky, recurring software revenue. Sumtech relies on lumpy contracts, so you're paying a hefty premium for potential growth, not buying a value play. And whenever we talk about paying a premium, we absolutely have to remember the recent Salomon IPO. As the research clearly points out, Salomon had massive retail hype. It was oversubscribed 76 times. But because its fundamental growth and margins were weak, the stock plummeted right after it opened. The core lesson here for some technology is simple. Massive retail demand during the application phase does not guarantee post-listing price support if the underlying financials can't justify that 20 times PE multiple. Which brings us to where your invested money is actually going. Out of the roughly 33 million ringgit raised, notice that a massive 54.7% is earmarked strictly for working capital. Remember those 126-day receivables we talked about? Yeah, that stretched cash flow needs plugging. Meanwhile, that highly touted expansion into the Philippines, the very core of their exciting growth narrative, is getting less than 9% of the funds. As an investor, you've got to ask yourself, are you funding explosive future growth, or are you just smoothing out their current operational cash flow? Okay, part 5, the final IPO verdict. Let's pull it all together and see if this engineering firm deserves a spot in your portfolio. The consensus from the analyst research is crystal clear. The overarching narrative of capturing the semiconductor and data center boom, totally credible. These industries are growing like crazy, and some technology has the turnkey skills to serve them. But, and it's a massive but, at a 20.7 times PE multiple, this stock is priced for absolute perfection. There is zero room for execution errors here. If that Philippines expansion gets delayed, or if the semiconductor market cools down even a little, that high valuation could correct very sharply. So here is the summary of today's explainer. On the bullish side, you've got an experienced team riding real macro tailwinds with profit margins that have impressively doubled. On the bearish side, you are buying into shrinking historical revenue, stretched cash flow, and a premium valuation. Oh, and no dividend policy either. Weighing all that, the single most critical metric you must monitor if they list successfully is their order book. Right now, it sits at 39.1 million ringgit, which only covers about 7 months of revenue. They literally have to prove they can win new contracts fast to justify this price tag. So, knowing the hype versus the reality, what's your play here? Are you willing to pay a premium for a highly credible data center story? Or do the shrinking revenues and cash flow red flags have you sitting this one out on the sidelines? The facts and the numbers are all on the table. Now the decision is entirely yours. Thanks for joining me on this deep dive explainer of the Sum Technology perspectives. Keep learning, keep analyzing, and as always, invest